Hello, everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the basics of technical analysis. My name is Sasha and I'm a financial analyst from the research department at Fortrade, and I'm pleased that you've joined me for this presentation. But first of all, we will show you the risk warning and the disclaimer. We feel that it's necessary to show you this so you're aware of all of the risks. In this webinar, we'll be discussing the types of markets, a few of the most commonly used technical indicators such as moving averages, SMA and EMA, RSI, MACD, and Bollinger Bands, and confluence, a combination of these indicators and how to use them together in trading. Technical indicators can be very confusing and daunting for beginner traders, but they don't have to be. And this webinar will give you a basic understanding of some of the useful technical indicators, which should help to improve your understanding of the market. Firstly, of all the indicators I'm going to show you, take their information from basic price action. One of the most common mistakes traders make with technical indicators is that they overload their screen. Only display the indicators on the charts that you'll actually use. A lot of traders overload indicator charts as an excuse to overtrade. Remember, indicators are an indication of something happening in the market. They are not a crystal ball that will magically predict the future. Don't blame the indicators when a trade doesn't work out. No matter which indicator you use, you will always make some losses in trading. So there are two main types of markets, as you can see on the screen: trending and range-bound or sideways markets. A trending market looks like this, as you can see here on the left-hand side, when the market is moving in one direction. A range-bound market at the top here, or sideways market, looks like this when the market is moving up and down within a specific range. Indicators tend to be suited to either trending or range-bound and sideways markets. Moving averages. So first we're going to talk about these. I'm not going to talk about formulas. I'm just going to explain the basic concept and the way to choose options on the platform to suit your trading style. The most frequently used MAs in trading are SMA and EMA, so we'll focus on them. SMA, or simple moving average, simply takes the sum of all the past closing prices over a time period and divides the result by the total number of prices used in the calculation. For example, a 10-day simple moving average takes the last 10 closing prices and divides them by 10. A 50-day simple moving average takes the last 50 closing prices and divides them by 50, and so on. The 10-day moving average is more responsive to price changes than the 50-day moving. In general, traders can increase the responsiveness of a moving average by decreasing the time period and smooth out movements by increasing the period. So the exponential moving average. The exponential moving average leverages a more complex calculation to smooth data and places a higher weight on more recent data points. While the calculation is beyond the scope of this tutorial, you should remember that the EMA is more responsive to new information relative to the simple moving average, as it would focus more on most recent prices rather than on long series of data points, as the simple moving average requires. SMA versus EMA. SMAs weigh all of the same data in sequence, while EMAs weight more the most recent data. For the EMAs, the shorter the period, the more weight applied to the most recent price. An EMA is used to capture shorter trend moves due to the focus on most recent prices. By this method, an EMA is supposed to reduce any lags in the simple moving average, so the fitting line will hug prices closer than a simple moving average. EMA works well until prices break the fitting line. During higher volatility markets, you could consider increasing the length of the moving average term. One can even switch from an EMA to an SMA, since the SMA smooths out the data much better than an EMA due to its focus on longer-term means. So, how to use moving averages? Moving averages are helpful for identifying current trends and support or resistance levels, as well as generating actual trading signals. The slope of the moving average can be used as a gauge of trend strength. In fact, many momentum-based indicators look at the slope of the moving average to determine the strength of a trend. Many technical analysts often look at the multiple moving averages when forming their view of long-term trends. When a short-term moving average is above a long-term moving average, this means that the trend is higher or bullish, and vice versa for short-term moving averages below long-term moving averages. Moving averages can also be used to identify trend reversals in several ways. Price crossover. The price crossing over the moving average can be a powerful sign of a trend reversal, while the price crossing above the moving average indicates a bullish breakout trend. Often, traders will use a long-term moving average to measure these crossovers, since the price frequently interacts with shorter-term moving averages, which creates too much noise for practical use. MA crossover. Short-term moving averages crossing below long-term moving averages is often a sign of a bearish reversal, while a short-term moving average crossover above a long-term moving average could precede a higher breakout. Longer distances between moving averages suggest longer-term reversals as well. For instance, a 50-day moving average crossover above a 200-day moving average is a stronger signal than a 10-day moving average crossover above a 20-day moving average. The Relative Strength Index. This compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you see from the chart, it ranges from 0 to 100. An instrument is deemed to be overbought once the RSI is approaching the 70 level, meaning that it may be becoming overvalued and is a good candidate for pullback or reversal. Likewise, if RSI approaches 30, it's an indication that the instrument may be getting oversold and therefore likely to reverse. Traders often use the RSI, either coming back out to its overbought or oversold areas as a signal or a partial signal to enter a trade. Some tips on using the RSI indicator. Sudden large price movements can create false buy or sell signals when using the RSI. It is therefore best used with modifications to its application or in conjunction with other confirming technical indicators. Some traders, in an attempt to avoid false signals from the RSI, use more extreme RSI values as buy or sell signals, such as RSI readings above 80 to indicate overbought conditions and RSI readings below 20 to indicate oversold conditions. The RSI is often used in combination with trend lines, as trend line support or resistance often coincides with support or resistance levels in the RSI reading. Watching for divergence between price and the RSI indicator is another means of refining its application. Divergence occurs when a security reaches a new high or low in price, but the RSI does not reach a corresponding new high or low value. Bearish divergence, when price reaches a new high, but the RSI does not, is taken as a sell signal, as you can see here on the left. Bullish divergence, that is interpreted as a buy signal, occurs when price reaches a new low, but the RSI value does not, as you can see down here. MACD. MACD is one of the most well-known and used indicators in technical analysis. This indicator is made of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distance between them become the MACD. Convergence simply means that moving averages are moving closer together, and divergence simply means that they're moving away from one another. When the short-term EMA is above the longer-term moving average, the upper area of the indicator will show activity. When the short-term EMA is below the longer-term EMA, the lower area of the indicator will show activity. The center line, which MACD is plotted around, indicates where the EMA are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, usually marked in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26, and for EMA it's 12, and 9 for the signal line. The further apart the EMAs, the greater the momentum. The further away the MACD will be from the center line. Traders use MACD and signal line crosses to indicate momentum trades. You can see how these crosses often match with market moves. Traders often use crosses to indicate where momentum is coming out of the market and use it as a signal to exit a trade. A classic trading strategy using a MACD histogram is to trade the divergence. One of the most common setups is to identify points on a chart where the price reaches a new swing high or a new swing low, but the MACD histogram doesn't, which signals the divergence between price and momentum. Unfortunately, divergence trade is not that reliable or accurate. It fails more times than it succeeds. Prices often have several final volatile bursts, up or down, that trigger stops and force traders out of position just before the move actually makes a sustained turn and the trade becomes profitable. Bollinger Bands. Bollinger Bands, which I'm sure you've heard of, are a highly popular technical analysis technique. A Bollinger Band is plotted 2 standard deviations away from a simple moving average. So it is made of a SMA, the middle line, and then 2 standard deviations plotted away from it. Now, the most important part is that because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, moving further away from the average. And during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an indication of the volatility which is about to rapidly increase, as volatility often follows periods of lack of volatility. The market spent most of the time within the bands, and when the price action reaches the edge of the bands, it's more often likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI indicator, which I was talking about earlier on. It's not a standalone system. Bollinger Bands should be used in conjunction with other indicators because they're simply one indicator designed to provide traders with information regarding price volatility. It is suggested to use them with 2 or 3 other non-correlated indicators that provide more direct market signals. It is crucial to use indicators based on different types of data. Some of them can be moving average, divergence, convergence, MACD, and relative strength index, RSI. Using multiple indicators and their signals to take a trade, that's confluence. Here we have the RSI and MACD we've already looked at. With RSI moving into overbought territory at the beginning of the chart, remember that indicates that the market will reverse. However, we want something to help us filter out false signals on the RSI. So also look at MACD to give us confluence. We can see it is indicating momentum is coming out of the market as far as the market rallying or going up is concerned. And we have a MACD cross on the graph as a signal to enter a short trade. We can also use the opposite signals as exit signals to indicate when the momentum is coming out of the market and it's more likely to reverse. If the market retrace backs up in an opposite direction to our trade, this can be used as an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with Bollinger Bands and moving averages. We can see the market is at the top of the Bollinger Band, but we could also wait for the MA cross before taking the short trade. And now we have a confluence of 4 indicators. We have an RSI coming back out of overbought. We have a MACD cross with the market going to the edge of the deviations on the Bollinger Bands. We also have the 2 MA crossing to the downside. This is the sort of confluence you should be looking for with technical indicators on various markets to see how you can find opportunities to take profitable trades. Well, I hope that you found this presentation useful. If you have any questions, please contact a senior account manager. Goodbye, and please join us at 4Trade again soon.